Dear investors, in this edition of Market Outlook, we would focus on Q3 result season gone by and the key takeaways from there. Volatility expected in the coming period, and lastly, valuations and market outlook. On the first topic, Q3 result seasons. Overall, the result season was in line with expectations. However, there were more companies which missed estimates than which met estimates. Once again, overall, post the result season, the outlook on financial 22 and financial 23 EPS has remained more or less unchanged. IT, financials, discretionary, and telecom spaces delivered better than expected numbers. Metals again provided the sharpest profit growth. Consumer staples, healthcare, downstream oil, and city gas kind of spaces, and of course, cement delivered lower than expected results. Higher commodity prices did result in margin squeeze for commodity users. While the commodity users did increase end product prices, yet it will take another quarter or two to fully pass out the input price increases to the end consumers and for margins to get restored. Overall speaking, our universe delivered a PAT growth of 22% versus 25% of Nifty. For 9 months, the situation is reversed. The PAT growth for the universe was 48% versus 45% for Nifty. This kind of points to the narrowing of profit growth to larger companies. Ex commodities, metal and oil and gas, Nifty delivered a PAT growth of only 12% and broader universe delivered 13%. We need to watch the narrowing of profit growth, mainly on account of margin squeeze. Sales growth has continued to be strong, while because of margin squeeze, which is like 2.5% ex financials, the EBITDA growth is just 12%. Because the broader markets have seen their numbers be in line with Nifty or maybe tad lower as well, it is causing the breadth of the market to fall, and we need to keep a track on this. On a 2-year basis, the earnings growth continues to be healthy at 27.5% for our universe. After the result season, earnings outlook has remained broadly unchanged for financial 22 and 23. However, there has been some negative impact in higher P sectors like consumers, apart from, of course, autos and metals. While outlook has improved a tad for oil and gas and BFSI, which are both lower P sectors barring one-off names. This change in profit drivers is expected to put a pressure on index valuation. This is a point that we have been noting. Coming down to our next topic, the coming period is expected to be volatile. There is a confluence of many factors, some of which we try and analyze as below. Point 1, inflation has been high. It's been higher than the range that can be tolerated. As it happens, there is a policy response. Liquidity reductions are happening, and interest rate increases would start in the West and in India as well. So we had been focusing on inflation as being the biggest risk to the market. That seems to be bearing out. It was thought to be transient in the beginning, but it is proving to be more enduring and is finding support from unforeseen spaces like the Ukraine geopolitical standoffs. And that is causing expectations on rate increases to go up very sharply. While earlier it was 2 to 3 rate increases during the year, now the expectations are between 5 and 7 rate increases as the year progresses. QE of the Fed would finish off in the month of March, and From June onwards, Fed balance sheet could start to shrink by US dollars 100 billion a month, just assuming they don't they just let the securities mature and don't do anything beyond that. The direction from the Fed would be followed by many countries. Many countries have seen the balance sheet of the central banks expand, and this is the phase wherein it would be corrected. India too could see repo rate increases as GSEC yields have spiked up while repo rates have not. GSEC yields typically move ahead of repo rates. Repo rate should start to follow in some time. Increase in yields do cause currency volatility, leading to stock market volatility as offshore participants take defensive action. Moreover, for earnings yield to bond yield valuation metrics, something that works for us. In the absence of upward earning surprises, prices would have to adjust downwards. Inflation, yes, there is a hope it can get controlled as logistic costs reduce. We saw a sharp improvement after the last COVID wave, and logistic costs had normalized, which again spiked up. Now, again, as COVID is fast normalizing, the hopes on this count are rising. RBI is guiding for a CPI inflation to tend towards 4% versus 6% now. And we do believe that if inflation comes back in the range, the interest rate increase expectation and the pace of interest rate increase both could moderate. However, the current expectations do raise concerns of interest rate increasing actually ending up impacting growth, something which would not be good for equity. And in India, one has to remember that we have not seen fuel pump price increase for a month or so, and post elections in 5 major states, the same could happen. So our inflation actually could rise before reducing, and that has to be seen. As we speak, the geopolitics around Ukraine and resultant high oil prices are definitely impacting market. While the situation is far away, this is just another factor which is hurting. Crude prices are nearing $100, seeing a sharp jump from $75 to a barrel just a quarter back. Crude is the largest component of the Indian import basket, and a $1 increase in crude results in over $1 billion extra cost to India. In the current situation, in the current period, the situation seems to be worsening. In the response to the crisis, sanctions may be imposed, which will further disrupt normal trade. Let's see how this situation unfolds. I do expect some normalization of geopolitics over the next few months, as it always happens, which will lead to some normalization of crude prices as well. However, till it happens, the market sentiment could continue to stay negative. The next point is higher margin requirements in Indian derivatives market. This is a rule which is coming in from March 1st. It got postponed last time around. This time around, as yet, there is no news on that count. What it basically means is that participants in the derivative markets would have to make available more cash to sustain their positions. The cash can be obtained through borrowing from, let's say, an NBFC, or through selling of their stock positions, or from some other sources. But if you look at the spectrum of possibilities, some of them at least involve selling their holdings in the marketplace to raise cash, and which means an added downward pressure, selling pressure in the market. Next, of course, there is this election related uncertainty the country is seeing elections in 5 major states. Uh, in the context of the K-shaped recovery that we have spoken about, where a section of the population has not yet participated in growth, I do believe the election results would be followed closely as a prelude to the general elections, which would come in 2024. Uh, I do expect government policy making to stay positive and growth oriented to reduce the stress that weaker sections are facing. And we have seen this over last period as well. Lastly, India is seeing its largest ever IPO hitting the market, and LIC is coming into the market. It could raise large sums of money, 65 to 75,000 crores by some estimates. Large IPO does suck out liquidity. So, a lot of times one has to look at the money flow into the market to gauge the direction of the market. Various things are happening over the next period, which points to lesser liquidity being available to buy stocks, and which means, at best, the secondary markets could remain range bound. For a large, maybe attractive issue, the way it works is that for a fully invested fund manager or even an retail HNI kind of an investor, they would have to sell a part of what they own to make space for this kind of an issue into their portfolio, which results in some amount of selling pressure. Yes, a large issue always gets in a new section of retail investors into the market. We do sense a lot of new folios being opened, and if the issue does well, overall it could really result in sentiment changing for the markets. In the past, we have seen this happen when a Maruti issue happened at the beginning of 2000s. It was a success and it did change the direction of the market. So on all of the above points, I need to say that there is already an expectation that is already built into the prices. Okay, markets have corrected a bit. From January till now, we are probably down just about 2%, while earnings have moved up. Hence stocks have seen some amount of valuation correction. We will come to valuations in a moment. The point is that if the outcomes are good, as they can happen, or less impactful versus feared, the market could move both ways. So yes, it will be volatile, but one has to remember that some bit of it is already built into prices, and over a period of a month, chances are that while volatility will be high, the direction of the markets could be sideways and maybe a tad down. Overall, this is something that we have pointed out earlier in relation to US taper, as to how tapers, while it brings in volatility, ultimately the direction of the market is decided by factors pertaining to us. We believe growth in earnings and valuations are two factors that ultimately decide the market outcomes. Earning outlook still looks strong enough, but the upward revision in expectations is probably coming to an end, and more coming from commodity spaces. Coming down to valuation, this is something that we will develop a bit more in this outlook section. Valuations continue to be higher than historic valuations. Okay, Nifty is still trading at a forward PE of over 19.5, 6.5 to premium to 5 years, 19% premium to 10 years average. Like I said before, down 2% versus beginning of the year. While changes in the composition during this period makes the longer term comparison less relevant, and thankfully so, it still leaves some scope for valuation correction. If 5-year average valuations hold, which we believe there's a good chance of that happening, then Nifty could see a level of 18,500 over the next 1 year, delivering just about double-digit return, something that we have been pointing out since the beginning of the year. A low probability event, of course, is that the Nifty valuations tend towards its 10-year average, which could then mean a close to a 0% return for Nifty in this year. However, like I said, that would be a low probability event. Uh, Hence, overall, in terms of market direction, I continue to maintain that one should expect returns less than earnings growth to account for some valuation correction. This is also since earning momentum is more seen in spaces where P's are lower. This year could be a year of two halves. In the first half, commodity price inflation would cause margin stress while users increase finished good prices to account for the cost push. In the second half, as commodity prices decline, the opposite could be true. Investing themes for growth investors hence remain the same and include, of course, beneficiaries of China plus one. We are invested under this theme in chemicals and bulk drugs. Textiles are other spaces which are seeing a strong traction. PLI beneficiaries, this has happened across sectors, but mainly in electronics, and we are exposed there. Unorganized to organized is a big theme seen in diagnostics, for example, jewelry and footwear segments. Beneficiaries of focus on work from anywhere, digitization, cloud, internet businesses are benefiting IT services and internet businesses. As interest rates start to increase, financials would benefit from higher interest rates. As time progresses, as the uncertainties get resolved, I think some of these themes will again manifest themselves in the market. Some would be tested, yes, as the world normalizes post-COVID. So, for example, higher competition from unorganized could hurt consumption names, which are benefiting from unorganized to organized shift. Lower commodity prices is something that we believe would happen, and that would benefit the branded players in both staples and discretionary. So these are interesting times. We are staying focused on the long term with best quality businesses which have a great compounding potential, and believe this is the best manner to benefit from any volatility. Presently, since intense selling pressure is seen from one segment of the market participants, the FPIs, stocks where their presence is higher are underperforming, seeing selling and underperforming, versus spaces where domestic HNI retail funds presence is higher, is holding out much better. The point is how, as the selling pressure declines, the same stocks can bounce back quickly as the growth thesis stays intact, the themes stay intact. And like I said before, most of the uncertainties that we have talked about, we would find answers to the same over the next month or so. And hence, if one uses this kind of a volatility over the next one period on downticks to build a high quality portfolio, this should prove to be a good strategy. Thank you and happy investing.